Welcome to Stocks in Translation. I'm Jerry Blikre, your host, along with the people's voice, Sydney Freed. Thank you for joining and tuning in. First, some housekeeping notes. Be sure to like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, Amazon, or YouTube. And today we are welcoming back Steve Sosnick, Chief Strategist at Interactive Brokers. Steve, thank you for coming back here today. And it is a big day. We're going to be talking about how the markets are digesting election results. Full disclosure, we are taping this Wednesday, the day after the election. So we know the next president. The Republicans took the Senate, and we know the House is still up for grabs, but we don't know what the Fed is doing. And our word of the day, it is risk. Thought we'd go a little broad on a risk-on day. This episode is brought to you by the number 3.79%. That is where the bond market sees the Fed's benchmark rate at the end of 2025. Why rates are heading higher. That's right, higher. So Steve, big markets day here, big everything day. What's your first blush take on everything?
Well, Jared, first of all, thank you for having me, and good to see you, Sydney. I think today what we're seeing is really this, that you mentioned it is a risk-on day. Mm-hmm. Now, we've been risk-on for the better part of 2 years, when you really think about it, but we've removed the uncertainty as to who the president will be. We now know who that is. I don't know that we have policy certainty, but we have a better sense of the direction that we're going to take. Markets weren't particularly perturbed with either candidate. It's not as though markets performed very poorly under the Biden administration. Mm-hmm. We're obviously coming into this off a very solid run with that as well. But markets see the possibility for lower tax rates under a Trump administration. That's catnip to investors. Yes. They always want lower tax rates. The fly in the ointment, however, is that's not necessarily good news to a bond investor's ears. And that's going to be the push-pull as we go forward is, on a day like today, where you could argue that some of the fact that rates are higher, as we're taping this sort of between 10 and 20 basis points, between 2s and 30s, some of that might be the risk-off mentality. Some of it might be risk-on mentality, I should say. Well, some of it might be the bond market perceiving risks off, whereas the stock market is risk on. So you could get a real push-pull there.
All right, so there's a lot of nuance in there, and we're going to pull it all apart. And I think this is a perfect time to introduce our phrase of the day or word of the day, risk. So here we go. Risk is a chance that an investment's actual return will differ from the expected return, potentially resulting in financial loss. So we try to quantify it. We try to manage it. We never really escape its reach. So within the context of this, and it's very broad, what does risk mean to you?
Risk, well, that pretty much sums it up. Risk is the sense that things will not go your way all the time. I think what happens is, and a lot of investors focus on reward. Mm-hmm. There's always this sort of, in theory, there's sort of the yin and the yang of the investment world. There's risk versus reward, but I think a lot of times people get very focused on reward without much of an idea of what risk might be. And I think when you get into an environment where things are a little frothy, people lose sight of that. I think about some of the days where, when the market's down, call it 1.5%, and I get freaked out phone calls. Why is the market down? Why is the market down?
Because it hasn't been down 2%, in a long time.
Exactly. But it's sort of, the idea is markets are supposed to go up. They do go up over time. But I think we get focused on the reward and not on the risk. And risk is always out there. And risk has a nasty way of biting you at exactly the wrong time.
So, Steve, we just talked about how markets have been on the up and up for a while now. What is the biggest risk you see heading into 2025?
Well, there's policy uncertainty. Will the tax policies, will sort of the protectionist policies have negative effects on stocks and on the economy? Might they have inflationary impact? The litmus test for that does come through the bond market. And so I think if you continue to see bond yields lifting, that could be a headwind for stocks.
What about the potential for, we're going to hit the debt ceiling pretty soon. We could have to shut down the government as well. So we got two issues there, and we don't know who controls the House. So it seems that there's going to be some policy uncertainty for a little bit of time there. How important is that, that these things get resolved quickly? In other words, the debt ceiling and the debt limit.
The debt ceiling and the debt limit's a weird thing. I mean, I think we're the only country that actually has this. I think Denmark is the only other country, but Denmark, they just rubber stamp it all the time. And that used to be the case here. Now, like everything else, it's become politicized. I think it's one of those things investors don't react to until it's like really staring them in the face, because it's usually there's brinksmanship that gets resolved at the last minute. Nobody really wants it.
Always gets resolved.
Well, we're still here.
Exactly, we're still here. But you have had situations where it took a while for it to get resolved. But usually it gets resolved like at the last minute. It's sort of like, like a high school student turning in their homework at the last minute. Eventually.
The risk is that every once in a while they get caught.
Yeah.
Exactly.
So
there you go.
Turning a bit back to the markets, we're seeing really big moves in the Russell 2000 small caps today, almost at a record. But we have high rates too. And we've talked to a lot of guests who've said that small caps don't really like higher rates. So kind of what's going on there?
Small caps don't like higher rates because many of them are, many of the stocks in the Russell 2000 are money-losing stocks, which means they have to be able to borrow money to stay afloat, which means they prefer lower rates. All borrowers prefer lower rates. And so at this point, we're a very debt-heavy economy, but those stocks, in many cases, really need debt as a lifeline. But in the short term, the idea that, number one, protectionism probably helps these companies more than most. Microsoft doesn't need a lot of protectionism, right? I mean, Alphabet, these companies are fine.
they got their moats.
They have these big moats and they're fine within them. Company number 327 in the Russell 2000, and I have no idea what it is. I just picked a number sort of at random.
Yes.
That company probably does not have a very big competitive moat. And so odds are some sort of protectionist policies, America First type of policy, would help that company. Second thing is we may get a change at the FTC, almost definitely get a change at the FTC. The current chair, Lena Khan, has been fairly strident about putting the kibosh on mergers that she and her commission view as anti-competitive. It's probably fair to think that whoever would replace her would be a bit more lax about that sort of thing. It's part of the whole deregulatory ethos, I think, that we have. And so small cap stocks are more likely to get taken over. Again, nobody's taking over Microsoft, but somebody might take over that number 327 company, if its prospects are good.
We've seen the November to December timeframe just explode in stocks very consistently recently. And we're just talking, you can go back in the presidential elections, but even to November 2023, November 2022. And I had a question, how does seasonality affect your analysis? Because a lot of people were expecting this election to kind of unleash this wave of CapEx. It was something I was writing about in Morning Brief. And in the U.S. presidential cycle, predictably, after the election, you get this wave of investment. How much does this play in your analysis?
Not too much. It's out there. I keep an eye on it, but seasonality has a way of working until it doesn't work. And
it's been good recently.
It hasn't. So September, for example, I did the work on this, and I think, what was it, like 4 out of the prior 5 Septembers had been negative coming into this year. September was gangbusters good. And as it turns out, over the 10-year period, though, it was like 50-50 as to whether it was going to go up or down. November has had a great track record because October and September tend to be 2 of the worst months. But September was a great month and October was a down month, but only slightly. So literally not until the last day of October did the S&P flip into negative territory. So seasonality, I think, is less important right now than momentum.
We definitely
one
have
giant momentum trade, and you talk about it all the time on air, and you notice, you recognize it. You're a technician at heart. The trend is your friend, and this trend has been extraordinarily powerful. And investors and traders alike have been, both, have been riding it basically.
How do you think about your own investment thesis when seasonality doesn't kind of line up with what we expect?
That's kind of why I take into account seasonality, but I don't trade off it.
I think you have to kind of trade off it consistently. Like if you don't take the signals consistently, you miss out.
But even when I've looked for some consistency, and I don't have I can't spout the link off, but I did put a link up on our website, IBKR Campus. I'll throw in that little
Yeah, we'll put it up on.
Yeah, and I'll send you the link and we can put it in. But I did do some work on it, and the seasonality, it's too inconsistent to be really tradable. So I think it's part of investor psychology. Of course, we've all heard the phrase "sell in May and go away," but we never really know what are we selling and where are we going necessarily. But and certainly, and the flip side of that would be then the November to May period tends to be the best, which you can document over time, but it's not perfect, and certainly on a month-over-month basis, it's a little too random to really, I think, make too many heavy-duty decisions.
We'll leave seasonality there.
Yeah. What do you think about the VIX? We're seeing it tank today.
Well, you just
move down.
You just removed a big amount of uncertainty, didn't you? The VIX. We all look at the VIX itself, which. Again, let me.
You can't trade it, by the way.
You cannot trade VIX directly,
which is confusing to me. But anyway, keep going.
It is an index. Well, you can't trade SPX either, but there are futures that trade on it and ETFs that trade on it, and that's the case with VIX. There are VIX futures and there are VIX linked ETFs. So that is how you trade it. But one of my going phrases is, and I probably have used it with you before, is VIX is not a fear gauge. It just plays one on TV.
We spent some time on that.
I know.
On the previous episode.
I know we discussed that before. So I'm going to bring it up again. And what it's telling us is, remember, it's the market's best estimate of volatility over the coming 30 days. And you had an election. And VIX tends to decline once a big event is behind it. So the election's not a factor in volatility anymore.
Imagine what happens after the Fed.
Well, I was going to say, what about the Fed meeting? It's not really a factor there for tomorrow?
Can we just pause right there and we'll talk about the Fed after this break? Because coming up, we're going to take on Jay Powell and the Fed's rate path. And on a Who Wore Better, it's NVIDIA versus Intel, but we're going to do some time travel as well. All right, we are back. This episode is brought to you by the number 3.79%. Now, that is where investors think the Fed will lower rates to by December 2025, next year. So the important thing to know is that this terminal rate is up almost a full percentage point higher than where it was when the Fed first cut in September, and that wasn't that long ago. So markets are seeing fewer and fewer Fed rate cuts, Steve. And what are you making of this?
Well, I think in general, the Fed funds crowd has been ahead of the Fed pretty consistently. Remember, think back to January when we were discussing how are we going to get 7 or 8 rate cuts in this environment.
Didn't seem plausible.
Guess what? It wasn't.
Yes.
We've gotten 2, and at most we're going to get 4. And I'll assert here that we'll probably get the 3rd tomorrow. Again, we're taping this the day before the FOMC meeting. The Fed is not big on surprising markets, so I think they'll probably just go through with it. But it's not clear. It's not clear that we're going to get the December rate cut, and certainly it's not clear what we get in terms of 2025. And again, the bond market's telling us that things might be going the wrong way in terms of inflation and indebtedness and things of that nature for the Fed to really go gangbusters in cutting rates. Bottom line is, I'm going to ask this sort of as a hypothetical. I've been of the camp of, what do we really need it for? When you think about what
more rate cuts?
More rate cuts, right? I mean, okay, so the Fed's dual mandate is stable prices and full employment. Well, yes, we've seen disinflation, but the inflation rate has sort of flirted with the 2% target, but we seem to be sort of finding our level there. And I would argue we have something similar to disinflation in the labor market. It's been slowing down, but it hasn't really slowed down. It hasn't tipped over. So 4.1% unemployment rate still means that essentially 96% of the people who want a job have one. That's a historically enviable employment rate. Plus, you've had average hourly earnings in the 0.3, 0.4% range month over month, which is actually above CPI, which is good if you're the average worker. And of course, none of us really, I don't know who that is, but in general, when you have wages in general going up faster than CPI, that's a good thing. And you have credit spreads, the amount that when companies borrow money based on their credit, they pay a spread over treasuries because assuming the treasury can print money.
They're not paying that much more right now.
That spread is almost at record lows, and the stock market is hardly suffering from a lack of liquidity. And you're certainly seeing speculative investments, going gangbusters. I mean, look at Bitcoin,
Bitcoin,
stocks, et cetera. So why exactly do we need aggressive rate cuts? It's not clear to me why.
It's not clear to me why, but are you concerned with this potential reacceleration in inflation?
Yeah, or the no landing, basically, if we're going to talk landing.
It's possible because, I think that this election may have raised that specter a bit because tariffs are potentially inflationary. If they're going to go ahead and deport millions of workers, that's inflationary. There are certainly reasons to think that inflation that we may. I'm not going to go out and say that we're seeing a real acceleration in inflation right now, but the potential exists that it's possible we may have gotten what we're going to get on the inflationary front in the short term. A lot of that depends on the new administration's policies.
Anything the Fed needs to watch out for maybe next year, new administration, just not necessarily even in the administration, but things in the economy that they might need to deal with that they haven't had to deal with before?
Well, I mean, to some extent, they had to deal with some of it 4 years ago. But I think, again, if you're getting into a situation where there's protectionism, one of the things of globalization means that it's allowed. You go to Walmart, you buy from Amazon, or Temu if that's your cup of tea. Those are sort of they've been sort of disinflationary elements for years because they've been able to source stuff globally, much of it from China, but source it globally where it can be made more cheaply. If that reverses and it's made in America, there are certainly. I understand the appeal of a made in America policy, and I'm not gonna go down that political road. But from an economic point of view, if you're forcing consumers to buy something that's made potentially in a higher cost jurisdiction, that does not help inflation.
I mean, these are long-term secular trends that we're talking about. Maybe structural inflation that's higher. That we'd have any other long-term trends you're thinking about that might be applicable here, because we get caught up in the day-to-day, what's going to happen in the next 3 months, 6 months, whatever, but long-term trends.
The long-term trend that's been driving the stock market has been the love affair that we have with AI.
And we haven't talked about that much.
I was waiting for it.
I knew
as you started your sentence, I was like, he's going to say AI.
All right, we need funfetti when we have a word, some kind of trigger here, but yeah.
Like the secret, so you have the secret word. And,
yes.
Definitely.
But, at some point, and we started to see it a little bit this earnings season, the investors are kind of wondering, okay, all these billions of dollars are being spent. Again, there's the old analogy that in a gold rush, you should buy the people who manufacture the picks and shovels.
Yeah.
Well, the semiconductor manufacturers are the picks and the shovels. To some extent, then you have, I guess, the big mining companies. Whether it's Microsoft, whether it's Google, whether it's Alphabet, the same company, or Meta, I should say. They've been spending billions on AI. It's not clear that there's much of a return there, and even more murky is what the benefit of AI is for the average everyday company.
I think B of A just crunched the numbers, and I was actually just writing about this, so I happen to remember some of this, but they crunched the numbers and they realized that these big CapEx investment cycles, the companies who invested in them don't tend to perform that well in the stock market in the years afterwards. So it gets back to your pick and shovels argument. Maybe it's not going to be these hyperscalers here.
Or maybe it's just really, really long-term play. We got to wait another decade or so.
Figure out monetization in 2031.
Exactly.
Well, that's the internet. Think about it. That was what happened with the internet.
Took a while to figure out.
Cisco, Intel were the big companies in the internet era, And it took a while. The internet did actually revolutionize business. It just didn't do it immediately.
This is a perfect segue here, because guess what? We're going to do a time warp on who wore it better today. First, let's travel back to 1999 when Intel was a tech darling that got the big invite to the Dow Jones ball. It was the height of the dot-com era, and Intel's processors were ubiquitous. They were everywhere. Now, fast forward to 2024, we've got another chip darling, minting money for Jensen Huang and the NVIDIA shareholders. Of course, that would be NVIDIA. The very nuanced question here, Steve, is who's wearing this Dow nod better? Which endorsement speaks more strongly of the company in the spirit of the times? Was it Intel and the dot-com boom, or is it today NVIDIA? And we don't have the benefit of history that way we do with Intel, but
I think the analog is tremendous. I don't know we won't know who wore it better.
It raises good questions.
But it does raise good questions. And bear in mind, Intel was added, I think, in October of 1999, just in time for things, like call it 6 to 9 months before the whole cycle changed. I hate to think that the Dow committee did the same thing with NVIDIA.
The Dow committee.
Well, it's S&P Global now. But
it is S&P Global now. I know that's, but it's part of my general distaste for the Dow. If you'll let me go down that.
Oh, please.
If you'll let me go down that road.
We love opinions about the Dow. It's a people's index.
It is the people's index, but I don't know which people.
Oh, wow. It's not the people's voice, it's people's index.
I like the Dow because it only has 30 stocks. Yeah. That's my hot take. It's not that hot.
And that's the problem.
Yeah.
It's 30 stocks. It's 30 relatively arbitrary stocks. It's,
it's very arbitrary. It's
why Sherwin-Williams as opposed to Dow Chemical?
Is it like America's stocks, kind of?
Yeah. It's meant to be America's stocks. It is. But remember the little history here about the Dow. Please. It was created in I think in 1896. The original measure was the Dow Jones Utilities, but remember, what's the technology that was available to the people creating?
I don't think they had radios.
They didn't. They didn't have a lot. They had a pencil and paper, and so it was an index. So it was an average because that's what you could do on the fly. You could
do it.
You could add up. You could add up exactly. You could add up 12 numbers and divide it by 12, and there's the movement. And to be fair, there wasn't really a great way to measure markets beforehand. So there it went. Mm-hmm. The problem is, as we now live in a computer age, we can measure things by market cap, where you take the stock price, multiply it by the number of shares, and then divide it.
We were doing that in the 1920s once a week with the S&P stocks.
Exactly.
But only once a week.
Once a week, and it was like, I think it was originally the S&P like 100, 90, and then 290, and then 270, and then eventually in the 50s it became the S&P 500 because they could do it, if not real time, relatively quickly with the newfangled computer technology that they had. And so, is it the ideal index? Not necessarily. Here's the problem I have with the Dow, and why, if I were your editor, I would banish from your air and all the other ones.
This is going to be good
because it's price weighted, because that's what an average is. You take the 12 prices and divide and sum them and divide them. In this case, the divisor changes because of splits and everything, so it's not 12.
But you're still adding and dividing.
You're adding and dividing, but only by the price. So therefore, the things with the biggest price have the biggest weight. Goldman Sachs, UNH and Goldman are number 1 and number 2. At the bottom of the list is Verizon. The market, which is, so Goldman has a $550-ish price, and Verizon's about, 37 or 40 or something of that nature. So Goldman has, call it 12 times the weight of Verizon. The market capitalization of both those companies is almost exactly the same, within a few $1 billion. They're both about 150 some odd $1 billion. Is there any reason why Goldman should be twice as important? And let me bring it forward. How much time do you spend talking about NVIDIA versus talking about Sherwin-Williams in your reporting?
What is this disdain for Sherwin-Williams?
I have no disdain.
These are great rhetorical questions, and I emphasize rhetorical because we have to close here. 24 minutes has passed by. Make sure you check out all our other episodes on our home site, mobile, and podcast platforms. Keep your dial tuned to Yahoo Finance.